Hello there. Today's Wednesday, April 30th, and welcome to the Kluge Wealth Advisory Group Client Connect video. In this video, we're going to touch on a number of items, including frequently asked questions, but we're first going to start off with a portfolio review for the month of April and a general wrap-up on what's been going on. Now, before we get going on this week's video, I just want to note that we are going to step down the frequency of these videos to bi-weekly, given the fact that markets appear to be settling at this point and the pace of news has slowed down substantially. Now, we still want to keep a higher cadence than the monthly updates we were doing previously, and we do stand ready to step in and produce videos more frequently if the pace of news events does keep up. So let's get right into things here and get into that portfolio review. All right, let's get right into things here. For the month of April, there's no way around it. All portfolios, irrespective of risk level, were off to some degree or another over the course of the month. But the good news is that there was a significant recovery between the lows of the month, which seemed to be put in around April 7th and 8th, and the end of the month here on April 30th. So that's good news. Another piece of good news is that diversification and portfolio construction worked. During the course of this entire pullback, fixed income and alternative strategies have definitely provided an anchor for the portfolio. And so that in and of itself is a positive sign that one of the major components that we rely on for risk management continues to work even under these unusual circumstances. Now, another thing I want to touch on, but didn't want to spend a whole bunch of time because we have talked about this before, is the fact that during the correction here over the course of March and April, we were buyers of weakness and have definitely been able to acquire high quality stocks at discounted prices, and I believe that will provide good return going forward. Now, before we move on to everything else, I did want to also note here that we are starting to see some positive signs in the market. Now, just given the fact of who is involved and the fact that one press release can change this all, I don't want to be overly focused on short term. However, if we look out with a 6 or 12-month window, which is still relatively short term, if we take a look at quantitative studies or sentiment-based studies, we do see that there is a fairly substantial rate of return that is associated with current market action, current levels of sentiment, and current market patterns. A couple of examples of market patterns that have been extremely positive that come to mind. The first is the fact is that the volatility index, which is broadly referred to as sort of the fear index, did move up all the way to around 60 and then very, very rapidly then closed under 31. Now, statistically, when this has happened in the past, that has indicated that you've seen a major trading low in the market, and that has occurred. The second thing is that we saw some very unusual volume action. There was 2 days in a row in the last couple of weeks where the number of stocks in the market, over 90% of them were up 2 days in a row. That's extremely unusual, very rare, and usually is associated with the reemergence of an uptrend. Although it doesn't have to appear right away, it is definitely associated with strong 6 and 12-month returns. And related to this item as well is the fact that on last Tuesday, the NASDAQ index had a 100% update, which means that every single stock in the NASDAQ index was up 100%. Was 100% of those stocks were up by some degree or another. Now, again, that's not a guarantee that you can't have more short-term volatility, but it is, again, from even a short-term perspective of 6 or 12 months, a very positive signal. Now, the bottom line is that when you take a look and you aggregate all of these sentiment-based studies, which look at how investors are feeling, and these quantitative-based studies, some of which I've noted here before, some of the signals that have occurred, generally what we're seeing is the forward outlook is that over 12 months that you would expect, it would be very historically normal to see a return in the 20 to 30% range. Now, I'm not guaranteeing that and I'm not predicting that, but what I'm saying is that if we were out here and it's 12 months later and the S&P 500 was 7,200 and not 5,500, that would be completely normal, completely expected, and frankly, from a statistical standpoint, would be unremarkable. So with that in mind, let's also talk about some of the things that that are still worrying investors, and then what sort of what the picture looks like in relation to those worries. So the key worries that are still impacting investors writ large are fears that the tariff tussle will turn into a tariff Cold War. Another fear is that inflation will reemerge, and a third fear is that equity earnings, stock earnings will drop substantially from here. So Those are all three worries that would definitely drive markets down lower. And in terms of where we're standing right now, it doesn't appear that any of those worries are coming to fruition. Trade deals are being negotiated, and even in the tense situation with China, there is definitely some sort of a dialogue happening, as far as you can tell. Earnings have actually been very strong. We're in the middle of an earnings season right now with a lot of companies reporting, and so far, according to data aggregated by Evercore, earnings growth is 17% on an annualized basis, which is very, very strong and far above expectations for 11% growth. So that's very, very good. And also, there is no indication of recession. I know that there was a headline recently about a negative US GDP print, but that has more to do with how GDP is calculated statistically and the effect of imports. Now, there was a surge in imports in the first quarter of this year. Partially that was importers trying to front run tariffs. Partially that was imports of gold. That led to a very large import number. Imports subtract from GDP, and so you ended up with a negative quarter. A better measure in this situation, where you're not going to, that's going to take the distortion of imports out, is just looking at domestic private consumption. And domestic private consumption, in the United States indicates that the U.S. economy is growing at about a 3% rate. So I don't think this negative GDP print we've seen is indicative of a recessionary situation. And as well, you're not seeing any indications in the bond market, of recessionary indications, like the high yield bond spreads or the extra interest that low quality borrowers have to pay. Those amounts are coming down. Those spreads are coming down. And again, in a recessionary situation, lenders would charge more to the highest risk borrowers. So, and one final positive thing we did want to note is that the market, although we're still dealing with the aftershocks of the tariff shock, the market is responding properly and normally to positive and negative earnings. Companies that beat expectations and raise guidance are being rewarded with higher stock prices, and companies that fail to meet expectations or provide negative guidance are seeing lower stock prices. So just as with the fact that the diversification did provide benefit during the current turbulence, we are seeing that the market itself, and that's normal, we're also seeing a normal fact is that good earnings are being rewarded and bad earnings are being punished. So those are all positive signs. And I think when we look at the situation is that there's a lot of room here for cautious optimism. Welcome back. Now let's get right into our frequently asked questions here. We're going to break this frequently asked question segment up into two sub-segments. The first, there's 2 or 3 rapid fire type questions that I'm going to touch on. And the second question that we're going to sort of group of questions I've grouped together require a bit of a longer answer. And so I'm going to put that into a different segment. So in terms of the rapid fire questions, one of the ones we got a little bit here over the last couple of weeks was, why do we rely on these quantitative studies of market pattern and sentiment? And the bottom line is that these type of studies, they just take the emotion out of the equation. When we're in a stressful situation, we want to be making decisions that are based on a very cool head and a very thoughtful process. And the bottom line is that these type of quantitative studies do emphasize the point and do really quantify and make real the point is that even though bouts of market volatility happen for different reasons, the outcome is very, very similar over time, which is a big positive, and I think is a very, very important North Star to keep us all on track. The second question we got quite a bit was regarding the Canadian election and the outcome here. So the bottom line is that from an investment standpoint, we're really not at a point we can make any decisions. Mark Carney is only recently elected, and we don't know which Mark Carney is going to show up. Is it the businessman Mark Carney, who is going to promote productivity growth, promote business, and promote policies that generally promote prosperity? Or is it going to be the Mark Carney that was the advisor to Justin Trudeau, where we saw different types of policy outcomes? Leaving my personal political biases aside, the bottom line is we just don't know which type of a prime minister he wants to be or will be. And so we have to wait for some indications on that before we make any decisions. Now, the final question that we saw quite frequently, when we've already alluded to the question here, was just around the negative US GDP print that we saw here actually on April 30th. Now, again, I did touch on this in my previous segment, but the bottom line is that this negative print is more to do with statistical a statistical nuance versus an actual contraction of the U.S. economy. And the bottom line is that it is there's a surge in imports created by conditions that are not being replicated, and so it's very unlikely that you'd see something like that again. And frankly, that drag on GDP that we saw from net exports is going to disappear statistically over the next couple of quarters. And measures of domestic consumption show the U.S.'s economy is growing at a healthy rate. So those are some of those rapid fire questions, and then we'll take a break here and we're going to move on to the next segment and deal with one of the longer group of questions that require a bit of a longer answer. Welcome back. Let's get into our second group of frequently asked questions here. Now, there were a lot of questions that kind of all revolved around the idea of saying, look, like there's been a lot of volatility recently, and we've seen a lot of articles or heard that there's been a big shift of away from investing in the U.S. into investing in other markets. Is this going to affect your strategy? Is this going to cause any changes? When would you do things, etc.? So I want to address these questions in a bit of a longer format, just so that we're able to really give a fulsome answer here. But for those of you who prefer a shorter answer, the bottom line is that, no, we're not going to be making a significant shift in investment strategy here at this point. Number one, you never want to do that when markets are down. It's usually a time where you end up locking in losses as opposed to finding new gains. But even bigger than that, the bottom line is that there are three North Stars that I use to navigate the investment landscape. One, which I talk about frequently, is sentiment or emotion, or if you want to, as I prefer to term it, human nature. The second is that you want to own high quality stocks with high earnings growth that are anchored to long-term themes that will allow that earnings growth to continue. And the bottom line is there are a number of very, very powerful investment themes that are currently occurring and currently permeating the economy and the population that are best accessed through US listed equity. And third, the bottom line is that earnings growth drives share price. And companies with higher earnings growth tend to have higher share price appreciation, and markets with higher earnings growth have, again, historically always had higher share price appreciation. So I'm going to take a few minutes and dive into each one of these categories. But again, for those of you who prefer the 2-minute answer, the answer is no, and those are your 3 reasons. But let's get into a little bit more of a detailed explanation here. In terms of touching on these 3 reasons, at the end of the day, I think what's happened here with the Trump tariff announcement on Liberation Day, air quotes, was that it was a shock to the system. Based on research and based on conversations with the research sources that I subscribe to, it's very clear at this point that that Wall Street, air quotes, was expecting President Trump to address financial deregulation first and tariffs second. And by addressing tariffs first and in such a aggressive manner, that sent shock. That really surprised folks. And the tariff announcement definitely, like I said, it was a surprise. And I think we're in a situation where, emotionally and from a human nature perspective, it was like everyone touched a hot stove and had to pull back. I don't, and human beings, human nature being what it is, emotion takes over at the margin, and decisions get made out of fear, and decisions get made out of greed, and that has helped to cause the current market volatility. So I believe that if you're going to make any sort of investment strategy change, you want to do it when sentiment is not at its lowest. You want to do it when when you might be able to leverage higher sentiment in one area and move to lower sentiment in another. Now, the second thing we want to talk about is, the North Star that I use to assess investments is long-term themes. Like, what are the things that haven't changed really, over the last few months, or frankly even the last few years. And when the bottom line is that whether Donald Trump is president or Kamala Harris is president, whether Mark Carney was elected or Pierre Poilievre was elected, there's a few long-term investment themes that are not going to change over the next few years, and frankly, in one case, not change over the next few decades. So the first of these themes that is not going to change is the increasing role and increasing investment in artificial intelligence. It's very clear at the current time that there's a very high rate of return that companies are earning by investing in artificial intelligence capability and expanding the reach of that type of a service. A very concrete example would be in ServiceNow, which is a holding in our portfolio. ServiceNow was able to grow its its revenue 18% last year, and did so with very few extra members of its staff, very few extra headcount, because they were using their own AI technology to become more efficient. So there's clearly a very high rate of return on artificial intelligence, and we're going to see that theme, investment and capital expenditure in that realm, continue for some time. The second, and this is a decades-long theme, is that the millennial generation is beginning to hit its peak earnings and peak spending years. The last time we had a shift like that, a handoff between generations, was in the late 1990s when the boomers hit their peak earning years and peak spending years. Millennials consume differently, and so we need to be focused on investment themes and consumer discretionary that more fit the millennial themes. Another trend that's not going to, it's going to be long-term in nature, is the role of financial deregulation in the United States and the impact that that's going to have on increasing bank profitability. U.S. banks are going to be subject to a lower level of regulation if the announced plans from the Trump administration go through, and that is going to lead to a rapid acceleration of earnings growth for both big banks and small. Another theme that is going to be very long term is the fact that there is a systematic and there has been now for half a decade a shortage of labor in North America and the United States in particular. So that with themes around innovation and healthcare, energy and cybersecurity, these are all themes that are going to outlast any prime minister or any president, and in some cases may even are going to really take us through to the end of our investing lives. So we want to remain focused on that. And the third thing we talked about here was the role of earnings growth. It is very clear from from the historical track record and from the evidence available that companies that are able to grow their earnings faster see faster share price appreciation, and that markets that have, at an aggregate level, higher earnings growth appreciate faster than markets with lower earnings growth. And this is why there's been such a gap in the last 2 decades between the share price appreciation seen in US equity versus share price appreciation seen in the rest of the world. And again, whether we like it or not, it does not appear that this is going to change. The US market is made up, and some would say dominated, but we will say composed, of companies that are very, very levered to those themes we've talked about, that are long-term, they're powerful, and they are attracting an enormous amount of capital. And by that, and as such, a lot of U.S. companies have very, very high earnings growth rates that are much, much higher than what you see in Europe. Based on data from the London Stock Exchange Group, you would expect, the expectation for 2025 is that Europeans' earnings growth will come in somewhere between 5 and 8%, and that American earnings growth is going to come in the mid-teens. So depending on where you want to, use the numerator and the denominator, U.S. earnings growth could be double, or it could be 50% more, depending on what numbers you want to throw in there. But the bottom line is that no matter what number, the way you do it is that it's extremely an extremely big difference in earnings growth. So I appreciate that there is an emotional reaction to what's happened here, and that frankly I am viewing that as an opportunity, which is why again don't want to belabor this, but we have been buyers of the weakness, because at the end of the day, if you have a high quality company that has high earnings growth and that there is a very clear long-term runway for that earnings growth to continue, there's not a guarantee, but there is a very, very high probability that that stock will attract capital, and if it attracts capital, it will go up in price, which is allow us to help you to serve your goals, your dreams, and your ambitions. So I know I've glazed over the top of this, and this is actually a very, very nuanced discussion that we can have here. But I want to provide a bit of an answer to that question writ large. And again, if you have a question on this, or there's anything else in your financial life or the financial life of your loved ones you want to touch on, please be in touch. We'd love to have a conversation. We're here to help, and we look forward to speaking with each and every one of you in the near future. Thank you very much.